There are 12 different loan programs that we're going to review in this video depending on who you are. So we're going to get started with first-time home buyers, primary residence, meaning you're going to live in that property. Let's get started with FHA. So many people know about FHA. The pros are that you can buy a house if your credit scores are 580. You can put down 3.5% down payment, and it allows you to stretch your budget 54%, which we don't recommend, but it does allow you to stretch your budget there, right? It's one of the easiest credit qualifying, but there's a negative thing about this too, that the mortgage insurance with 3.5% down payment, it never goes away. It's there for the life of the loan. Eventually, you want to get, refinance your mortgage into a conventional one, but it does allow you to buy a house with 580 credit scores. Good part is that there are other loan programs like HomeReady and Home Possible. This is a conventional loan program, allows you to put down 3% instead of 3.5%, right? 3%, and you do need credit scores of 620, and your maximum debt to income ratio is 49%, right? It is a conventional loan program, and your mortgage insurance does go away once you hit your 20% equity. But with this one of the restriction is your income, that your income must be 80% or below your area median income. If you don't want to worry about the income, then you maybe want to look into HomeOne. HomeOne, very similar guidelines, but you must be a first-time home buyer and it must be a single unit. HomeOne is that it must be one unit. HomeReady and Home Possible, your income must be below 80% area median income. If you don't want to worry about any of these two, then I would go with conventional conforming loan, right? Similar guidelines, 620 credit scores. You can put down as low as 5% on this loan, and your mortgage insurance does go away once you have 20% equity. If you're self-employed, right, or you are independent contractor, right, and you don't want to provide your tax returns, maybe it doesn't allow you to or qualify you enough based on your tax returns, there's a bank statement loan, right? This loan is a non-QM loan where we do need your credit score 700 or more, but you do need to put down 20% or more as well. We're simply looking at 12 months or 24 months of your bank statements, and we're seeing how much money was deposited each month and qualify you based on that. If you don't want to provide your bank statements, you can go with non-QM 1099 loan program where you're simply providing your 1099s, and we can use 90% of that income. Very similar guidelines as your bank statements. And if you're a real estate investor or builder, right, you probably want to go with DSCR. We're not looking at your tax returns. We're not looking at your bank statements or your 1099s. We're simply looking at the property that you want to buy, and can that rental income for that property cover your mortgage payment? So if your mortgage payment is $5,000, we want to make sure that the rental income from that particular property is going to be more than $5,000, and a bank appraisal will verify that information. And if you're a business owner and or investor trying to buy a building, you have a commercial loan, you have fix and flip option, and a ground up construction option as well. Very similar guidelines to what we see in our DSCR, okay? And if you already own a house, there are two different loan types. One is called HELOC and the second one is HELoan. HELOC is like line of credit, much like a credit card, depending on how much you're going to use from that credit line, versus a lump sum with your home equity loan. These are fixed rate. This is adjustable rate. So if you really want to get into more details, you can call us 516-218-1297.